I am joined once again by Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Danielle, great to have you back on Forward Guidance.
It's great to be here, Jack. Great to be here.
Danielle, I think it's a sign of the times of just how quickly things are moving and how much is going on that you're back so soon. Yesterday, Fed Chair Jay Powell gave his speech, raised by 25 basis points as many people expected. But he began the speech by saying that conditions in the banking sector have improved, and about exactly actually 2 hours later, shares of PacWest Bank were cut in half, 50%. And there's a lot of turmoil in the banking sector right today, just in terms of the shares with Western Alliance, PacWest, and other banks as well. Just how did you experience that 2 hours, let's say between 2:30 p.m. when Jay Powell said conditions of the banking sector have improved since March, and then 4:30 p.m. when PacWest shares were cut in half?
And my perspective is that Jay Powell is going to do and say whatever he can to be able to maintain a tight policy stance. And I don't think that he believed that the banking system was sound and resilient when the words came out of his mouth. But again, I'm going back to my soapbox. I think that he is of that, or he said, he said that was his view of the banking system before he turned into Jay Powell Esquire, the lawyer, and kept saying that what was happening in banking was really not at the Fed's doorstep. It wasn't under the Fed's purview. This was the responsibility of the FDIC. So I think he's really trying hard to deflect Fed policy, to separate Fed policy from what's happening in the banking sector.
Right. Okay. So what is he saying? What is his domain, and what is he saying is not his domain? Because originally in 1913, the Federal Reserve was started to prevent bank panics, right?
It certainly was. I mean, in 1907, J.P. Morgan himself gathered a bunch of men in his parlor, bankers, and said, "Hey, I will die one day, and we'll have to be able to have a central bank. We're no longer a developing nation. We're a developed nation. We're going to have a central bank so that we can prevent panics and runs in the future." So that is certainly under the Fed's purview. And I would argue, though, that financial stability itself has not been impaired. And that is really what we're talking about now. What we're talking about is the difference between bank failures. Don't get me wrong. I don't take lightly what's happening in the banking system, but we still have not seen systemic risk break out. Financial stability is not under siege right now. And we have to make that distinction. You have to consider that the stock market's still up, 6% year to date, and bond yields have come in.
Right. Okay. So what do you mean when you say financial stability? Let's unpack that, because bank lending is tightening. It was tightening before these issues in the banking sector started, and it certainly the pace of tightening has accelerated.
Mm-hmm.
But when you say it's not tightening, do you mean it's not 2008 where it's sort of one bank falls and then another bank falls?
No, I think that there are definitely dominoes lined up. But when I say that it's not systemic yet, it's because we're not reading about contagion in other countries. We're not reading about contagion in other financial systems. We're not reading about an AIG being taken down by a Lehman Brothers, which is from one industry to the next. There are issues throughout the financial system. There's more debt in the financial system than there was going into the great financial crisis. And that's one of the reasons that we're seeing the fallout that we are today. We knew that it was kindling and it just needed a spark. But the question is it contagion? And for the moment, even though we're watching one bank fall after another, it has yet to become contagious.
Okay. How many more bank shares have to fall, get cut in half before it's contagious?
So I think, I think that part of what we're seeing emanated from the likes of Greg Becker, who was the CEO of Silicon Valley Bank, successfully lobbying Congress to not be as heavily regulated as a bank the size of Silicon Valley or First Republic should have been. And had there been more regulatory insights, more regulations, higher capital requirements, I don't necessarily think that a lot of the loan books at these banks would have become as concentrated as they were. There were a month ago, the top 10 banks in the United States ranked by their exposure to commercial real estate. Guess what? 9 and 10 are gone. And that tells you that, boy, do I miss Eric Rosengren, who was the president of the Boston Federal Reserve, who I think was wrongly ousted from his position, given the small amount of trading compared to Clarida or Kaplan in Dallas. But he, for years, and the reason he was in line to be head of supervision and regulation, the reason that Eric Rosengren's name was being bandied about as replacing Randy Quarles as vice chair of bank and supervision was because he did have a good handle on the banking system. And for years, he had been saying and raising the red flags about too much concentration in commercial real estate, especially at smaller banks. So it's not as if there weren't people that were close to the financial system who were aware of this. It just seems like we've had the wrong policemen on the wrong beats. And look, say what you will, but something's wrong in the 12th district of the Federal Reserve. It was under Janet Yellen that the subprime crisis blew up in her backyard. And it's under Mary Daly that these regional banks that are overly exposed have not been properly regulated.
Danielle, I'm glad you brought that up. The 12th district of San Francisco. Right. And so, a lot of the banks that are having issues or have failed are from California, First Republic, Silicon Valley Bank. And a lot of the banks that are having issues right now are in there, such as PacWest, Western Alliance. What's going on with California? What's going on in that 12th district?
I would rather ask the question, what's not going on? And why are regulators not more embedded in those banks and more aware of, again, the concentrations in these loan books? First Republic had $58 billion of interest-only mortgages. That's a lot. I mean, no wonder they became banker to all the wealthiest people in America, because they were the one-stop shop. They were the one place that you could go ahead and get a 5 or 7 or 10-year interest-only loan for your mansion in the Hamptons or for your villa in Napa. But it was too much. It was too much for one bank. It should have been spread more evenly across the country's banking system. And that's what, and we saw with Silicon Valley Bank that they were overly exposed to the venture capital industry. And great, the deposits flowed in. That's understandable, but a more prudent regulator would have recognized that, if you're working for Enron Corporation, you probably shouldn't have your entire 401k in Enron stock. And yet that was the situation with a lot of these banks. And a better regulatory apparatus in that 12th district of San Francisco, I think, would have been able to identify these vulnerabilities. And that didn't happen.
And you've been sounding alarm bells about commercial real estate, but there are a lot of banks who have lots of commercial real estate exposure who are doing just fine, and who are their shares have not been cut in half. Is it more on the deposit side that just the bank run? Some people are calling it bank walk. I prefer the term bank skip. Hop, skip, and a jump. Is that sort of the issue? Just people withdrawing all of their money? Because you look at PacWest and their net charge-offs or allowance for, there are tons of East Coast and middle of the country banks that have a higher credit default rate than PacWest. But it's very low. And like Silicon Valley Bank, their capital call lending business, I think, had one default in the history of 30 years. So I feel like it's a problem that so far it hasn't been credit. And you're talking about credit. I feel like the credit issue hasn't even come yet. We're not even yet at the beginning.
We are not. And I think that is something that must be recognized. And if you think about right now, the hold to maturity issue that we've been talking about for weeks, which, by the way, is getting a lot better, right? A lot better with this decline in bond yields. You're going to have banks if this continues. And I argue that it will continue. Ira Jersey, one of my favorite analysts over at Bloomberg, he took his forecast for the 10-year yield down to 3% by year end. That's gonna cure a lot of the ills, regardless of what Federal Reserve policy does between now and the end of the year. If the bond market itself starts to take away some of these interest rate differential issues. But this has nothing to do with the fact that Green Street today came out and said, we're sorry. We understand you don't want to transact in commercial real estate. That cannot take away from the fact that CRE prices are down 15% year over year. So pretending that this credit issue isn't out there. I was listening to my buddy Lucky Lopez out in Las Vegas today. Kia dealerships are seeing people come in who bought SUVs at $40,000, $50,000 over MSRP, and they're coming in looking for a new car loan, and they're $30,000, $40,000 upside down in their car loans. So these are excesses in the system. This is bad credit, and we really have yet to see the fallout. We're seeing it on the corporate side. We've got large companies with $50 million or more in liabilities. We're seeing a run rate there, and that doesn't include Christmas tree shops, Jenny Craig, Vice Media. Those are three big ones that are in the queue to file as soon as this weekend. But even without them, we're seeing large corporate bankruptcies running at the highest level since 2009.
Wow. And all of this to say, Danielle, you mentioned that bank assets had been helped by the fact that bond yields had fallen. 10-year yields have gone down. 2-year yields have gone down. Some of that is the worry about the economy, which you were just referring to. Some of that is pricing in a Fed pivot. So, if there's 100 basis points of cuts priced in over the next year, suddenly my securities book is looking a lot better. But What happens if the Fed doesn't cut? And that's a perfect transition to the Federal Reserve did what many are saying is likely to be its last hike. Is it going to hike in June? Probably not. We'll see. I want to hear your views on that. But more importantly than do they hike is when do they start cutting?
So, maybe I'm going down with this ship, Jack. Maybe I need a life draft. Throw me one of those little donut-looking things, lifesavers. I get it. I think that the reason that Chair Powell in his press conference used the verb consigned as to the debt limit, that is an issue that is consigned to the fiscal authorities, is because he doesn't intend to necessarily come to the rescue of the sovereign with this debt ceiling issue in our face. If that's his stance, and if he can watch, again, I'm going to use the word controlled demolition, as long as there's no contagion, as long as there's no financial instability, as long as we're not seeing disorderly days in the market, and we're not seeing the VIX is at 20 for heaven's sake. And that's up. It was at 15 last week, but we're not seeing disorderly fallout in the financial markets yet.
But what would the VIX equivalent of the regional bank ETF be? That VIX would be at 60 or 100.
Of course it would. Of course it would be. Jack, I'm not denying that we're seeing these insolvencies. And that's exactly what we're seeing. We're seeing insolvencies. But if it's one insolvency at a time, even if it takes down many regional banks, and it does not ignite systemic risk. And let me tell you, when we're in a systemic risk situation, you and I will not have to talk about it. Yes. There will be not a scintilla of doubt. We will know it. We will know it if we wake up one day and Lehman Brothers has gone down and Richard Fisher, your boss, is saying, Danielle, what the heck is a Landesbank in Germany? And I'm like, what? What the heck is I don't know what. And they're smaller commercial real estate lenders in Germany, community type banks that happen to have really concentrated holdings of US subprime mortgages at the time. That's systemic risk. It comes from where you're not expecting it to come from, not from the next bank that was lined up. That by the way, traders have targeted mercilessly. And one of the reasons traders are targeting these banks, there's a 74% borrow on the bank index. One of the reasons they're targeting them is because they're looking after their book. They want to pressure Powell into this pivot. And they believe that they're going to be able to accomplish that feat, or we would see the stock market acting much worse. We would see investment grade and high yield spreads gapping out. We're not seeing that.
Yeah, it really is such a stark disparity between the sort of carnage in the regional bank stocks and then just the broader market. Yeah, the stock market's doing fine. VIX, 20, 19, 22. Credit spreads, investment grade, high yield, they haven't blown out. It really is interesting. And I just want to say, yeah, I think you're absolutely right that this is not 2008, at least not yet. And it's really not even close because there everything was connected, and Bank A falling, it was counterparted to Bank B, counterparted to Bank C. Here, the depositors, when they leave Bank A, they go to Bank B. So it kind of helps Bank B. And also, yeah, these are much smaller banks. But what about the economic impact? I mean, yeah, these banks, I mean, Pac West in the first quarter, their new loan originations were down something like 80% from the first quarter of 20. Now, not representative, but you get a few more Pac West, and this starts to cause some real economic damage. Isn't that part of Powell's parts of it? And by the way, is there a point of, actually Powell kind of welcomes these bank failures? I'm not saying that he does, but because it tightens credit, and he wants credit to tighten in order to tame inflation.
He does want credit to tighten, but he wants credit to tighten not just to tame inflation. A monkey can tell you that inflation's coming down. A blind monkey can tell you that inflation's coming down. But can a blind monkey tell you that private equity is really coming under severe strains? Again, this has not happened in 40 years. Now, we've gone through crises. Some of the worst stock market performance years have been years of crises during a time of zero interest rate policy and quantitative easing that bail out the wealthy and save private equity every single time. We've never crossed this Rubicon with the private capital markets being the size that they are. They've raised $6.4 trillion in the last 5 years alone, and they don't play by any rules, and they make monetary policy, Jack. And Jay Powell knows it. He knows that in March of 2020, he knows damn well that in March of 2020, Jack, that the hedge funds that had basically taken over trading in the Treasury market, because Basel III, other regulations told banks not to hold this stuff, not to trade this stuff. He knows that the entities that had garnered 50% of trading in these Treasury markets simply turned the lights out. They're like, oh, the ARB isn't there anymore. Bye-bye. See you later. And they step back. Now, these are some of the largest entities that are unregulated, that don't play by the rules. This is some of the brain drain after Dodd-Frank, when regulations with the Volcker rule, you can't run a hedge fund inside of a bank anymore. The same exact people who were behind the great financial crisis said, well, I can't play by those rules because I don't play by any rules. So I'm going to go create a new universe in which I don't have to play by any rules. And they've never gotten caught. They've had their wrists slapped, but they've never had CalPERS say, you know what? We don't want to pony up to your next fund. We don't care how big you are. 2022 was the first year of loss in private equity since 2009. And who's to say, with commercial mortgage-backed securities issuance down 79% year over year in the first quarter? These were some very badly done deals, but they were badly done deals because they could be. Because the traditional banks had stepped out of the business of lending. So let's just say that Jay Powell knows that the sanctity of the U.S. Treasury market was called into question in March of 2020 because of these non-bank players, and he wants to take the baton back from them and have Federal Reserve policy make monetary policy. Then he can say all day long and on Sundays, the banking system is sound, because he wants to maintain interest rates for long enough to make Fed monetary policy making independent again.
Very very interesting. Thank you, Danielle. So I think I agree with you on the fundamentals. Private equity and banks and investors in much the same situation. They bought assets at overvalued rates relative to where interest rates are, and that's a problem. How are you going to realize those losses? Banks, as you say, they play by the rules. Banks have to, if someone demands their money and say, knock, knock, can I have my money back, please? If it's a demand deposit, they have to give it to them. Private equity, no, as you say, they don't play by the rules. They've written their own rules, and they are gating withdrawals. And that sounds very negative and scary, and it is, but it actually, the shadow banking system can be, quote, safer because no one is allowed to take their money out. That you can always kick the can down the road. Whereas in banks, they're trying to kick the can down the road, but they can't. They're having a lot of issues.
That's correct. But would we have the same retail footprints that we have, some of these retailers going belly up, if private equity hadn't have had such just a massive influence? I'm Joe Q. I've got a great thing going. I've opened up the next hottest retail franchise, and I go to the bank for funding, and the bank says no. No, we don't have the balance sheet. We're not in that business anymore. So then you got to go to the private equity guy. And the private equity guy says, fine, I'll give you the financing. I'm going to lever you up to your eyeballs, but I'm not going to allow you to only open two new locations to expand your footprint. I'll only do it if I can write a big check and lever that up. And you have to open 10 new locations. And that's what I'm saying, Jack. I'm saying that part of what ails corporate America today is the structure of private equity and the way that they have forced upon so many companies too much leverage and forced them to grow to be too big, to where if and when we hit an economic slowdown, the business model absolutely collapses, and or worse, if we have normalized monetary policy, because the entire private equity framework breaks down if Powell maintains high interest rates. And that's my point. That's what I'm trying to get to.
And you think Powell is actively thinking about this? This is something that's motivating his policy decision as someone who used to work in private equity himself.
I do. And can you imagine? It's like, sorry, this voicemail box is full. I mean, they've all got to be going to voicemail at this point.
I think I know what you mean, but explain what you mean.
No, I'm saying he's not taking their calls.
You say people who used to work with him are calling him for help, and he's not picking up their calls. That's what
of course. Yeah. You just had the new head of Carlyle, which Powell used to work for, announce that they're going to be a little bit more prudent in the way they do business. Think about that for a minute. Powell's former employer. You know what? We're not going to be able to be cowboys anymore. But if Powell was taking the phone call and saying, no, the rules continue to not apply to you, I'll pivot. We'll go back down to zero interest rates, and I'll blow up the balance sheet again. I'll buy a bunch of treasuries. And next time I need your help in the treasury market, I'll look the other way when there's not a bid for the long bond in Asia and overnight trading, as was the case in March 2020, when these cowboys stepped aside, shut the lights off, and said, I don't get the profit. This doesn't work for how I do the trade. So I'm just not going to backstop the market.
And he's willing to make several regional banks, some of whom made serious mismanagement, incompetent errors, some of whom maybe did not. He's willing to make those regional banks a sort of sacrifice for his vigilante justice on his former employees.
I mean, vigilante justice is a really harsh term, Jack. But by the same token, he did say there was going to be some pain. And, I look back, Jack, at the day that he was renominated in November of 2021. 8 days later, in testimony to the Senate Banking Committee, he retired the word transitory, got rid of it because he could. He got that renomination. The day 6 months later, almost to the day, he finally got confirmed, because the Biden administration left him swinging in the wind for almost 6 months. November the 21st, 2021, he was renominated. May the 12th, 2022, he was reconfirmed with 80 votes in the Senate, by the way, held hostage so that Biden could put progressives onto the Federal Reserve Board. But the day, May 12th, 2022, he did a marketplace interview in which he said, the rules have changed. Inflation at 2% is my primary target. And by the way, it might cause a recession.
And Federico Powell, he never does an interview, except at the FOMC. It's very rare for him to be interviewed, except at FOMC pressers or highly specific conferences and events that Fed chair have been going to for many years. That
is right. That means that the marketplace interview was pre-scheduled on his schedule. He knew, because he's one of the most active, not political, burns my biscuits when people say that Jay Powell's political. He's shrewd. He visits more with lawmakers than any of his predecessors. He's not afraid to go up to the Hill and explain monetary policy and explain what his thinking is. So he's very communicative with Congress, but that doesn't make him political. There's a big difference. So he knew he had those 80 votes. He knew he had those 80 votes because he knew that he had formed good working relationships on both sides of the aisle.
So I just want to say the two meanings of the word political. One is, oh, I have left-wing political biases, right-wing political biases, and that's going to influence my policy decisions.
Mhm.
When or someone would call Jay Powell political, that's not what that would mean. We're saying he's strategic in the same way you go to the office, you form alliances with people you work with in order to reach a common goal. That form of political. Would you say that definition is applicable or no?
I would say that definition is that does define Jay Powell.
Yeah.
Absolutely, it defines Jay Powell, it's the president is mandated to nominate somebody for the position of the chair who's going to work with Congress, because the Fed exists at Congress's discretion. So you have to work with them. For heaven's sake, Janet Yellen was supposedly, when she was, in the beginning of her tenure at Treasury, they couldn't find her on the Hill. And this was a Treasury secretary.
Yeah. Fetcher Jay Powell, he's not in the econometrics doing algorithms, running the regressions, looking at the models. He's a relationships driven person. And you can see in the way he sends emails is very direct, and that's why he's had so few dissents.
And he's bitter. He's bitter against his own staff.
Tell me about that. Tell me about how so.
You heard the condescension in his voice. How many times in that press conference did he say, but those aren't my views? The staff makes good presentations. It's bless their hearts for having their own views. That's not my view, though. Very condescending. This is a staff that led him down the transitory path, a path to hell with their models. And he's made it very clear that he speaks his own mind now. And he's not going to be swayed by people who use great big words, jargon, and calculus and econometrics. He's not going there.
Powell yesterday, when asked if he had regrets, he said he did. He had several. Do you think one of those regrets was being convinced to go on the transitory path, which, as you called it, a path to hell?
Well, I think that actually started with this brainchild of average inflation targeting that he rolled out a few Jackson Holes ago. That's what got him on the path to allowing transitory to be what it was, because the staff had determined with their cute little models that you could let inflation run hot and average it with past year's inflation, which is the most asinine concept ever. That you can let inflation get out of hand because you're going to average it with prior year's inflation. Really? Where are real rates today, Jack? Are you going to tell me what real rates are based on 9-point-something inflation last year, or based on the fact that if you look at the Dallas trim mean, we're actually negative for the last 7 months on an annualized basis? Where are real rates? Because they're not what they were based on last year's inflation rate.
Yes. So I just want to say, when you're talking about Jay Powell's decision to retire transitory very soon after being confirmed, you're saying he was kind of playing along with the progressive economic view of essentially easy money forever. It's not, but I'm just going to call it that. And once he got confirmed and he's in that seat for, 4 more years, he's saying it's game on. My true beliefs. I'm a hard money man, not a soft money man. And let's let's raise rates. It's time. Like it's go time.
Look, he's worth $150 million. B, he could be worth billions right now as a person, as an individual. Had he stayed in private equity, given the fact that they've printed money these last few years while he's been serving his country since June of 2012, thank you very much. He could have been a billionaire by now, Jack, and he's not. But he's still worth over more than $100 million, meaning he doesn't need the Fed's pension. And he chose to stay in the post, despite the fact that his reputation by then had been shredded, eviscerated by transitory. He was a mock. He knew he was being mocked. And yet he still chose to maintain the path. Is that hubris? Because he doesn't really strike me as being kind of a Wall Street type big swing and you know what. That's not how he comes across at all.
Right. So you think those conservative money principles, I mean tight money principles of we need to raise rates, kill the Fed, but that's still motivating him. And that applies to, a bank here fails, bank here fails. Guess what? Banks fail, companies fail. That's part of life, part of capitalism. You think that is really what his view, and that it would be foolish for us to expect a policy shift from the Federal Reserve to be motivated by what's going on in the banking system?
I have said from day one, and I was the first person to say Powell will stand his ground. I mean, I look, a year ago, people wanted to carry me out in a straitjacket, thinking I was just flat out nuts. But I saw his resoluteness. I've read the 2012 and 2013 transcripts, and he is a sound money person, and he does not believe in the zero bound. He did get past the 5% threshold. Think about that. In 2018, he got the Fed funds rate up to 2.5%. That left him 2.5 percentage points to ease. He's got double that in his chamber right now, meaning if he needs to take the Fed funds rate down by 300 basis points, he can stop at 2% and say the zero bound was a failed experiment and stop. And so now he's hit that threshold, and I don't think we can discount that because of the amount of easing that's been done after the pandemic came that was done at the time. Now, quantitative tightening, quantitative easing, the balance sheet, whole nother story.
Oh, yeah, right. So, okay, I think that is a pretty objective and clear point that, yeah, Powell does not want to go to zero, does not plan to go to zero anytime soon or ever. But what about, go back to 300 basis points to help the banks out, help the financial system? What gives you confidence that, no, Powell is going to stay at that 5.25% that the interest rates are now at as of yesterday?
Well, the New York Fed came out with a study in April that said that they planned on the balance sheet being at $6 trillion by the end of 2025 before stopping and taking a break, taking a breather. That's kind of close to the 4.5% peak that it reached after the first run at quantitative easing. And my argument is, and we don't know what ample reserves are, we will find out, but if he cannot, in my mind at least, lower interest rates and continue with quantitative tightening. One effort negates the other. But if he gets interest rates up and keeps interest rates up, and that's all he does, just keep them high, then he can continue to shrink the balance sheet, which it's clear that the press corps was gagged again at this most recent press conference. It's a known. You do not ask certain questions. The statement was unequivocal in stating that the balance sheet runoff would continue, period, and nobody asked him about it.
Okay, so tell me why you think the press corps is gagged. And I just spoke to Nick Timrose, who I didn't even ask him, but he volunteered why he doesn't ask the question, which I'll incorporate later. But just quickly tell me why. Actually, I'll just say it. He said it's because he knows what the answer is going to be. It's that the policy is the policy. And, if, as a journalist, you want to ask something where they say something new. And it's the balance sheet is nothing new about it. They've been.
Well, then why was he pressed about 3% instead of 2%? He's not changing that 2% inflation target. Why did several reporters ask him the exact same question about whether or not it was really a pause or not, if they knew that they were going to get the answer? I mean, I understand what he's saying, but it's something of a gentleman and a gentlewoman's agreement. And if you really want to press him about that, I maintain that you might not get invited back.
Okay. Well, Mike McKee asked some hardballs. Steve Leisman asked a real hardball yesterday. Mm-hmm. I'm going to take a guess. They're going to be invited back, right? I'm just playing devil's advocate. I'm not. Yeah.
I didn't say you couldn't ask hard questions. I'm not saying that. I'm saying you can't deviate from the subject matter at hand. There's a difference. Mm-hmm. And if balance sheet policy is not on the table for discussion, it's not on the table for discussion. If you press him on a subject he's not willing to discuss, it's I won't even say it's poor form. I would just say that you would be identified.
And you think that would apply to senior reporters who, you and I would easily recognize, not just, someone my age who got lucky enough to ask a question, who's no more.
Look, Pedro da Costa pressed Janet Yellen about the source of the Medley scandal at the Fed. He was shown the door.
Yeah.
So I do think that there are lines that can be crossed for senior reporters.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Right. Okay. So tell me on the balance sheet, what are the questions that you would ask if there was no gag and you had an hour with Jay Powell? You had your own podcast. You were interviewing Jay Powell. He's telling you whatever you want. What would you ask about the balance sheet?
Well, I would want to know more the framework and thinking after 2019, which forced the not QE, because the market was starting to beg for quantitative easing, the big kahuna, which the pandemic gave them the excuse to relaunch. I would want to know how the framework had changed between then and now, the forensics that had been done by the New York Markets Desk to better understand and appreciate the ample reserve regime, where they feel that ceiling is in terms, where they feel that floor is, how much the balance sheet can be shrunk. I don't necessarily want to know a level. I want to know how they're thinking about it differently than they were before. I'd want to know if there would be a consideration for tapering quantitative tightening, for perhaps saying, as after December 2023, if the recession's bad enough, if we're starting to see some real liquidity issues throughout the financial system, if you would consider going from 60 billion treasuries per month, and by the way, they're almost on target there, if they would consider going from 60 billion in treasuries to 30 billion and then to 10 billion, I would want to know what their game plan was for extricating themselves from quantitative tightening, if that was going to be the same thing as quantitative easing.
Mm-hmm. You think that there's a just pattern for the Federal Reserve to get stuck in a certain policy? If they're doing QE, they tend to get stuck doing QE. And if they do QT, they tend to get stuck doing QT until there's a disaster, and then they stop doing it, and then they start doing more QE, and it's just one extreme to another extreme. By the way, QE, quantitative easing, increasing the Fed's balance sheet, quantitative tightening, decreasing the Fed's balance sheet in a long, sustained way, not lending, but actually buying and selling.
Right, and we're about to, while you and I are speaking, we're about to see 50 billion roll off that balance sheet while we speak.
Yep. Because of First Republic's borrowings that are probably going to be...
No, I'm not even referring to that. I'm just saying, I'm just talking about pure treasury runoff that as of the April 30 maturity that will be reported in the current week.
Yeah. And so how do you think quantitative tightening, which I think began in full swing last summer, $95 billion.
It rolled up to, it started in September at full throttle. And by the way, now you're going to see prepayment speeds begin to increase. So you're going to see more mortgage-backed security roll off.
So it will accelerate. That's interesting. And how would you say that has affected the market? Because, okay, you talk about offices. Everyone knows what an office is. You talk about mortgage. Oh, I have a mortgage for my house. It's very easy. A car loan. I wrap my head around that. But quantitative easing, and even for people who talk about it, pretty much every day, like myself, it's very hard. How have you seen sort of the effects of the quantitative tightening that started at full throttle in September play out over the past 6-9 months?
So I think we've seen it play out in the money supply, and it hasn't been as painful as it should have been by now, because with M2 is growing at the lowest level since 1937. When
it's negative, right?
Sorry?
Is it negative now?
Negative 4.03 year over year. That is the most negative since 1937. And by the way, it's always been in recession, not going into recession. It's been in recession. In fact, my favorite GDP model, now I sound like I'm talking like an economist, but my favorite GDP model is a guy by the name of Ben Herzon, who started off at Macroeconomic Advisors. He basically designed the GDP model, where you impute with every single data release what your GDP forecast is. He took his down for the current quarter to negative 0.1 today, based on the fact that there were so many fleet automobile sales as opposed to retail automobile sales.
Is it nominal or real?
Sorry?
Nominal, is that real or
Real.
nominal?
Real.
Real, okay, negative 0.1. Yeah, I mean, that's not, doesn't sound great.
No, and we saw massive negative revisions to the controlled group within retail sales for the months of January and February. So his revised first quarter estimate right now sitting at 1.1%. That could easily get revised away once we see where the dust settles on those March revisions. That's what I'm saying. We could easily be in recession right now.
Yes. And I want to sort of preempt something that some audience members may be thinking. Quantitative tightening removes reserves from the system directly, not deposits, which is M2, but they are related because when they reserve reserves from the system, suddenly the banks have to replace those assets. They have too much collateral, so they sell their collateral and then to people who have bank deposits. So they are related. So I just want to clarify that. So Danielle, is your view A, those banking issues are kind of overblown? Yeah, one or two, a handful may fail in the same way First Republic, but it's really not that big of a deal. Or two, or B, no, they will fail. It will be quite severe. Not 2008, systemic, globally, systemically, people in Spain are having issues because of the banking issues in America. Not systemic, but it will be quite severe, like, the savings and loan crisis or something. But Jay Powell is not going to do anything about it, and he shouldn't do anything about it. He's not going to save the banks, the regional banks.
I think that we are going to see more fallout. Absolutely. Again, as the guy at Green Street said, I'm sorry, but CRE prices are down 15% year over year. You can't do anything about it. So the loans are also not on the books at the right levels, in addition to the interest rate differential that is again shrinking. I will say, however, I had a good friend of mine today posit that rural America has been run over roughshod. Think about that. Think about what Ford and General Motors are doing to smaller dealerships in small towns, basically pulling financing, making them close. So now you've got to drive to town. My mom was from a very small town in Texas, but now you've got to drive to town to get your pickup truck serviced. That's going to be your closest Ford dealership. So people in small town America are pretty angry. And I would guess, and right now Randy Woodward's somewhere smiling, I would guess that there's going to be a lot of "it's a wonderful life" moments in the communities where they're not a bunch of, it's not Meghan and Harry and Oprah. They're not a bunch of depositors with more than $250,000 sitting in a bank. I would posit that you're going to see communities come to the rescue of their own community banks before they're wiped off the planet.
Danielle, Randy's watching this right now.
I know. Randy just loves that. Look, we're going to save the community banks. We have to save the community banks because we already know that, from a Bloomberg headline that the footprint of First Republic is very similar to that, micro geography wise, as to that of JP Morgan. And that, look, those branches will disappear.
Yep. And, First Republic, I mean, they lent a lot to, mansions in the Hamptons. First Republic, I think, many years ago made a mortgage to Mark Zuckerberg, founder of Facebook, I think at 1%, a little over 1%. I mean, this is just ridiculous.
It is. And it smacks of the haves and the have-nots. And that's why I go back, Randy Woodward, to the fact that I think we might be able to save quite a few of the smallest banks that provide lending for communities, and that we might not necessarily miss some of these regionals that are going away because of the way some of them built their businesses. I'm going to be the go-to for every wealthy person in America. Great, wonderful. What good are you doing again? And you're going to do it by lobbying Congress so that you don't have any regulatory overwatch. Great, wonderful.
Yeah, and they are, crony capitalism has a lot of, connotations, but it is a crony thing where the reason they gave Mark Zuckerberg a loan is a favor so that they do business with him in another thing. It's called tying, and in some parts it's forbidden. In other parts of the banking, it is allowed. And Silicon Valley Bank did a lot of tying. I mean, there are a lot of venture capitalists who they had their bank, they banked with Silicon Valley Bank, and that was a profitable business for Silicon Valley Bank. As a result, they got a mortgage at 100 basis points below what anyone else. I mean, it is a little ridiculous. So Danielle, you said we are going to save the bank. I presume some sort of American institution are going to save those community banks, and we should save those.
I'm literally talking about It's a Wonderful Life, like individuals coming to the rescue of small banks and making sure that the loans are money good. I'm not saying it's going to happen everywhere. We're going to lose some small and community banks, but there are a lot of Americans right now who are watching this unfold, who are going to have sons and daughters lose their jobs, and who, there are a lot of people who are going to stand up and say, we have taken enough. And we're not going to let you take away one more aspect of why we're not city folk.
Well, I hope you're right, Danielle, but I think there is a systemic issue that, individual people's motivations aside, these community banks have to pay more for deposits than JP Morgan or Bank of America because there's just a flight to those big money center banks that are in the big cities. And they're not earning enough on their loans to really make up for that. I mean, what institution is going to help those community banks, if at all? If it's not the Federal Reserve, is it the FDIC? Is it Treasury? Is it some other acronym I've never heard of?
You would think that would be an act of Congress, but that would certainly be a popular thing for a politician to do. Because
and totally opposite of the 2008 bank bailouts, where you had giant multinational banks with headquarters in Zurich, all offices all around the world, Tokyo, Zurich. Their equity holders, shareholders were bailed out. Totally different than depositors being bailed out of small community banks that the stocks don't even trade. Totally different.
Think of the kerfuffle when Janet Yellen was asked the question from the congressman from the state of Oklahoma. That thing went viral. Yeah. Let them go. Let them eat cake. Let them go. Who needs these small banks? Well, you know what? The communities need the small banks.
Yeah. And what does it say when a bank that, headquartered in Silicon Valley has a lot of venture capital loans, but, it does make mortgages to, billionaires and millionaires at 1%, 2%. That's declared a systemically important institution that doesn't get that, the exemption that you can give me the proper name for, I forget. But community banks that are actually making loans to people who need it, they're not.
And by the way, a lot of these, I'm not talking about, there are some community banks that are larger community banks that financed, skyscrapers in San Francisco and in New York City. Mm-hmm. I ain't talking about them, Jack, at all.
Yeah, and they're banks that are not community banks that have the word community bank in them.
Right. Yeah. They're not serving their communities, they're serving themselves.
Yes.
So I'm not referring to them, but I am referring to banks that are able to do due diligence and run the credit of people because they know their money good. And it's not because of their credit score, it's because they've known their family for generations.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code GUIDANCE10. Thanks, and let's get back to the interview. So, Danielle, yesterday, in addition to being asked, what are you going to do about the banks? Are the banks in healthy condition? To which Powell said, not really my problem, dodge responsibility. He was also asked about the debt ceiling, and he had a similar answer where he said that's the Treasury's role. And by the way, if you ask about the consequences of the debt ceiling, we can't even think about that. So he basically said, not my job. I want to hear your thoughts. How did you interpret that as it happened? And also, Janet Yellen, Treasury Secretary, recently said that the date at which the U.S. Will run out of money is going to be really soon, and that is causing a lot of drama. I want to get your thoughts on that as well.
So I think Yellen is becoming a little bit more political, a little late in her role, but she's definitely playing the strong arming right now and trying to expedite the calendar roll. She doesn't want to be the Treasury Secretary who shuts down the National Park System and the Smithsonian and furloughs a bunch of government workers, but that can happen. And when you consider how far apart, $5 trillion, nearly $4.8 trillion of spending cut suggestions that came from the GOP versus the Democrats who want to raise spending. So when you consider how wide the aisle is between the two political parties, it's going to take a lot to make these negotiations happen. And there's maybe it's a 10% chance that the United States actually does default on its debts. Of course, if that happens, it would be really bad. The credit rating of the country would get taken down, which, by the way, took Treasury yields down when S&P did it back on August 5th, 2011, because there was a flight to safety.
Yeah, yields down, price up. So Treasuries rallied even as their creditworthiness was degraded, which is paradoxical, but yeah.
And that's what happened.
Yeah.
But I think that if we went to the brink and went over the brink, that just like government workers who are furloughed get back pay, if we went right over that cliff and skipped an interest payment and the world ended and everybody in Washington said, oh my God, I'm not going to get reelected. My lobbyists are mad at me. If then it was resolved with entitlement reform, by the way, because that can happen, then we would go back and make those interest payments. We would make them up. Mm-hmm. So there would not be there would be a technical default, but there wouldn't be a missed interest payment.
Mm-hmm. Okay. So when you say Janet Yellen discovering her role, later as a politician, what do you mean by that? Just to put a point on it.
Well, some people think that the debt limit X date is not until the fall, not until September or October. I mean, for heaven's sake, California's federal income taxes don't have to be paid until October the 15th. So money will come in. And then there's quarterly tax payments that are coming in at the end of June as well. So it's not going to be popular. The emergency measures might begin to feel more like a great big emergency, but the X date's not in June. But for her to say that the X date is within days, within weeks, I mean, that's playing politics.
So it's kind of like, a high school principal needs the form by, September 1st, but they say they email all the kids and the parents, we need it by July 1st, just to have a little bit of wiggle room. That's it. Exactly.
Yeah. And she look, I think that First Republic might have gone down a week prior, and maybe they want it for that to be resolved on a Monday instead of on a Friday. Maybe they wanted to see if the probability of that rate hike on May 3rd would go down enough to strong arm Jay Powell into not putting through that last 25 basis point rate hike. Didn't happen. And by the way, Austin Goolsbee didn't dissent.
Yeah. So what do you think are the consequences of Jay Powell saying that he's not going to do anything? I mean, officially, central bank independence. Yeah, it's not his issue. I mean, he's doing his role, right?
He is technically it's not his obligation to be a politician. He's an unelected official. So it's not, he's under no obligation to satisfy the debt payments of the United States of America. In fact, he was part of a task force assigned to investigate how the Fed could be of assistance, since they do happen to own a ton of treasuries. Maybe you don't, maybe they provide grace on the treasuries on the Fed's balance sheet, and such that, if worse comes to worse, you can pay the interest on the public debt as opposed to the interest that the Fed holds. But he's saying he's not even going to go there.
All right. So sounds like you support Powell's insistence that the regional banking system has to figure it out, but by itself. They've got the FDIC, they've got the Treasury. You support that. However, credit is tightening, and we've got the debt ceiling, and you've been flagging all these recessionary issues for a long time. It does sound like the next year is going to be pretty chaotic. Is that fair to say?
Look, I think that this is going to be a really ugly recession. I do. I mean, I was howling on Twitter when Jay Powell made the most idiotic statement of his entire career a few years ago when he was like, you know what? I think we've gotten to the point where the United States never has to have a recession again. I'm like, what did you just say? Clearly, he's trying to sell that soft landing to this day, but he doesn't believe that anymore. And I have to wonder why he said that, but it was the stupidest thing he ever said. And we know that there's going to be recession, and we know that it's going to be painful. But if we can get back to what we were talking about before, there's something to be said for taking the reins back and controlling monetary policy again as the Federal Reserve, as opposed to having, a man who makes $1.3 billion dictate what monetary policy should be.
Right. Danielle, so you have been a stern critic of the Federal Reserve's easy money policy since the great financial crisis. So much so you wrote a book about it called Fed Up, which people should check out. I want to applaud your consistency for it now that the Federal Reserve's policy is restrictive. It is tight money, and Fed Chair Powell is not going to sort of bend to whatever monetary crisis is going on. You support Jay Powell, so I want to applaud your consistency of not constantly criticizing the Fed regardless of what, because there are types of people who they say that the rates were too low, and they're like, Jay Powell's rates are way too low, and then he raises by 500 basis points and they say rates are too high. It's like sometimes there's people to whom the Federal Reserve can't win.
That's true, and he's being absolutely crucified and vilified right now. But look, I'm sorry. In March of 2022, 25 basis points. The next meeting, 50 basis points. The next meeting, 75 basis points in June of 2022. At some point, you might start to take the guy seriously. And yet, so many continue to make loans as if the zero bound was imminent.
Yeah, correct. And they said, oh, there's no way there's another 75. I mean, the market's only pricing in a 50. And it's like, well, tomorrow the market's pricing in a 75, and now it's another 70. And it's amazing how many times that happened. But now we are at the end of the hiking cycle.
He's successfully every single time the financial media, and they say it every single time, this is going to be the last one. He's able to get his chief lieutenants out there in the media saying, you know what, we're going to go. There's justification for it. He said at the podium yesterday, even though jobless claims are going up fast, even though layoff announcements are coming in fast and furiously, he doesn't believe it. And I don't think he believes it. So call him. Hopefully he's got his hand behind his back with his fingers crossed. But he still said there's still 1.6 job openings for every capable American. He's still referencing and he's still saying inflation is just too high. So you could see a situation where if the stock market was to rally hard from today on, and this banking situation was because 2 weeks ago we were like, what banking crisis? Banking crisis? No banking.
It's a tremor. It's a little bit of stress, Danielle. Come on.
A little something, whatever. But if there's a similar kind of insouciance, if there's just a similar kind of, we got this covered, you could make a case for a June 14th rate hike. Mm-hmm. Because he's paying it. He doesn't talk about it, but he's paying attention to financial conditions.
Likely the pause is already here. Yesterday was the last hike in this hiking cycle, but the door is open is what you're saying. It's not a 0% chance. The door is open.
All I'm saying is if financial conditions ease considerably from here on out, if you see we've seen there was a short window of time that you saw investment grade corporate bond issuance and even junk bond corporate issuance zoom back up. That means the capital markets are open. Remember what caused the initial Powell pivot. The high yield market quit issuing bonds for a record 41 days. This time it went 25 days, but then it opened back up. Again, this is not systemic. We're not seeing issuance markets completely freeze over. We're seeing bankruptcies, but for viable borrowers, the capital markets are still open.
Yes. And inflation is still high, even though, as you say, a blind monkey can tell that it's going down. Danielle, I just want to close. Can you summarize your view on how interest rates can stay high, but the Federal Reserve will stop doing quantitative tightening, and how that ties into the Bernanke Doctrine, which you taught me about, but I always need a reminder of what that is. So what's the Bernanke Doctrine? How does that apply to the sort of delicate balance between keeping rates high or continuing to decline the balance sheet, or both?
So the Bernanke Doctrine, which I can guarantee you Jay Powell does not buy into, predicates that you have rates at the zero bound before you can launch large-scale asset purchases, which is how the Fed used to refer to quantitative easing. So one must precede the other. If you were to back that up, then in theory, you could not be lowering interest rates while at the same time shrinking the balance sheet, because you would be easing on one hand and tightening on the other. So maybe we get the Powell Doctrine.
Danielle, it's always a pleasure to have you here. Any parting words for our audience?
Look, it's going to get ugly. It's going to get ugly. But if we can keep our eye on the ball, if we can possibly break the grip that private equity has on the financial markets, on allocating capital, on hyper leveraging up companies and then watching them go bankrupt, which hurts small town American, on enriching themselves, which increases the inequality divide. This recession will be painful. It will be really, really painful. But we're going to eventually have to weather a painful recession to get to the other side. And if it requires Jay Powell to stay the course and keep interest rates at a high level and continue to unwind the Fed's balance sheet through this recession, then I think we should try and keep our eye on the ultimate goal here. And that is to make monetary policy independent again and to narrow the inequality divide that's opened up because Wall Street makes monetary policy.
Yeah, so I do have a final question. You talked about private equity. I feel like a sibling to private equity is private debt. So the purchasing or origination of loans that banks would make, but they're real money loans made from a fund instead of from a bank. You're having a lot of chief investment officers of private debt funds go on the channels, the financial news channels, and say, we are so thrilled. This time is a really exciting time to have a private debt fund because banks are stressed. So they're selling us loans at 15% yields, and our investors are going to get a great return. To me, it sounds like there are many things about that argument that make sense. What's missing there? What do you think about that?
Well, first of all, so I think private credit is going to have a little bit of a growing pain here. Fastest growing asset class we've ever seen in our lifetimes. $1.5 trillion right now. I think that there probably were some bad loans made early on in the infancy of this sector, but by the same token, they can take out private equity for pennies on the dollar.
What do you mean take out? Like
companies. They can take out companies that are backed by private equity and get big, fat, healthy yields. And they can take business away from the banks. And they can dictate the terms to the borrowers. Mm-hmm. I've actually had a complete shift in my thinking about private credit because of the moment that we're in, because they can get these really high yields for public pensions. Public pensions could, in theory, I'm writing about this today, which is why you just asked me an electric question. Jack, you just hit.
I'm glad.
That was the hot button, Jack. They don't have to say that they don't have to take it anymore as a lender, because borrowers these last few years have been like, covenants? You can't put any covenants on us. No. I think private credit is going to have a larger footprint and that they're going to be sounder investments for public pension funds, and public pension funds are going to be able to shed their alternative weight. Get rid of these private equity holdings, get rid of these alternative holdings. Hell, get rid of public equities that they hold, because they'll be able to get duration, asset liability matching, put 20% of their assets in these private credit funds. They already own, public pensions already have a 68% footprint in the private credit market. And they can take their other 80% if Jay Powell holds the line and stick it in cash, or put it in, you know what, everybody's like, who's going to buy the 10-year? And I'm like, well, I think you're going to have pensions lined up around the block if the Fed's not conducting quantitative easing, because they're going to be able to get out of the high risk high-risk poker game that they're in by being knee-deep in leveraged, gated private equity funds and be able to be in private credit going forward. And they're not going to be covenant-light anything. They're going to be actual loans to operating companies throwing off cash flow because right now banks are not able to lend. I think that this is going to be the next frontier of lending.
I agree with you. And I think, a key point of finance is it's all about the price. If you had a bank make a loan, a commercial real estate loan against an office building at a 5% yield, maybe they're not being compensated well enough for that risk. And the risk is there, as you've talked about. But for a 20% yield, that sounds like a pretty good deal. So new investors into private credit, that could be a good opportunity. Not saying it's particularly good for society, perhaps, but for new investors, it's good. But what about investors who are, as you say, the asset class has multiplied so much, who bought in 2021 when the private credit funds were making loans at 6% instead of 20%. Oh, and by the way, you have this whole volatility laundering thing about, oh, guess what? I've never had a default on my loan ever. In the same way private equity people say that I'm less volatile than the S&P 500. It's like, yeah, because you market once a year.
Again, I think there will be hiccups along the way. I think there will be some blowups, but I think in general, because they're going to be able to conduct sound lending, you don't have to hyper leverage up right now. You can just go out there and get the yield. It's not a zero interest rate environment where you've got to pile on the leverage in order to make any kind of a yield. You don't have to double, triple, quadruple down. You can just get a good yield, period, and no covenants. So they're going to be sounder loans than the type of financing that private equity has provided in recent years. I'm all for it. I'm all for it. And it would be a safer investment than some of the go-go juice that our public pensions are invested in. And that's why you saw so many of these public pension managers at the Milken Fund, at the Milken Conference come out and say they're white on rice. They're all kinds of ready for this because they've had covenant light shoved down their throats for a generation now.
Yeah, that was great timing. That conference. Danielle, a pleasure as always to hear your insights. Thank you so much for coming on. Thank you everyone for watching. People should follow your work at DiMartino Booth on Twitter. And where can they find your work of QI research?
So please come to dimartinobooth.substack.com. I am enjoying my new home at Substack very much. It's a great platform, and I'd love to have you come be. It's $59 a month, or it's $595 a year. They tell me it's stupid cheap, but I ain't changing the prices. So come become a member of the QI community, please.
There we go. Thanks again. Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.